This is an Uncovered Japan company research report on Kohoku Kogyo, ticker 6524. From Shiga Prefecture, this precision components maker holds two genuine world-leading positions: lead terminals used inside aluminum electrolytic capacitors, and optical devices built into submarine communications cables. The business combines a 26.5% operating margin with an effectively debt-free balance sheet. The central question is whether that exceptional quality can justify a valuation already above its own historical ceiling. The report is dated July 6, 2026, using a reference price of 5,910 yen from June 2nd. Kohoku traded at roughly 43 times forward earnings and 6.5 times book, both above their 5-year ranges. Yet the operating evidence is unusually strong: a 26.5% group margin, an 82.8% equity ratio, no interest-bearing debt, and 68% of sales overseas. This is an outstanding business thesis constrained by a demanding price. The lead terminal business makes the fine electrode parts that connect aluminum electrolytic capacitors to circuit boards. Kohoku produces about 5 billion every month, with more than 40% global volume share and over 60% value share. Its optical business makes isolators, filters, and related devices for fiber communications. In submarine cables, those parts must work untouched for 25 years or more on the ocean floor. Reliability is not marketing here. The segment split is the key to understanding Kohoku. Optical components and lead terminals each contribute about half of revenue, but optical produced roughly 83% of operating profit in fiscal 2025. Its margin was about 44.6% versus 8.7% for lead terminals. Lead terminals create scale and a broad demand floor. Optical creates the economics. For investors, submarine cable optical order flow is therefore the variable that matters most. Revenue fell to 13.5 billion yen in fiscal 2023, when optical projects entered an order lull, then recovered to a record 17.5 billion in fiscal 2025. Management guides to 19.6 billion in fiscal 2026. Operating profit recovered even faster, from 2.8 billion to 4.6 billion, with guidance for 5.4 billion. The trough demonstrates real cyclicality, while the recovery confirms that the competitive position was not lost. Fiscal 2025 net income fell by about 8%, even as operating profit rose 17.4%. The apparent contradiction came from foreign exchange. The prior year included a large yen-related gain that did not repeat. It was not a deterioration in the component businesses. Because 68% of sales are overseas, currency can make the bottom line noisy. The cleaner measures are operating profit and cash generation, both of which remain strong. Kohoku's optical moat begins before assembly. Unlike many overseas rivals that buy crystal material from suppliers, Kohoku designs the composition in-house, then controls polishing, coating, device assembly, and long-life testing. This improves quality, captures the supplier margin, and keeps process knowledge inside the company. It also supplies Subcom, Alcatel submarine networks, and NEC, regardless of which system house wins a cable project. That neutral position captures demand across the industry, rather than betting on one installer. The balance sheet is unusually conservative for a manufacturer. Kohoku held 8.4 billion yen of cash, had zero interest-bearing debt, retained earnings of 17.5 billion, and an equity ratio of 82.8%. That provides genuine resilience when optical orders pause between projects. It also allows the company to fund its planned Maibara facility internally while returning surplus capital. The trade-off is that excess cash depresses return on equity unless management puts it to work. The core optical niche already has very high market share, so medium-term growth must come from industry expansion and adjacency. AI and data center traffic supports demand for new submarine cables. Kohoku is also pursuing satellite communications, semiconductor equipment, and a third pillar in quartz glass lenses. A new Maibara site is planned for 2028. The opportunity is credible, but these newer domains remain unproven, and submarine cable projects will still arrive in uneven waves. At the report's reference price, forward earnings traded near 43 times, above a 5-year range that topped out at 33.1. Price to book was about 6.5 times, versus a historical ceiling of 4.7. The average broker target was 5,300 yen, below the market price. Strong AI and cable expectations, rising capital returns, and momentum explain the re-rating. But the valuation now embeds sustained execution and leaves little room for a normal project lull. These are the report author's assumption tests, not price targets or investment advice. Over 3 years, the bear case is about 1,850 yen, the base case about 3,900, and the bull case about 6,550. The reference price of 5,910 already sat close to that optimistic outcome. The base assumes solid optical growth and a still premium multiple. The risk is that slower projects and multiple compression can occur together. To conclude, Kohoku Kogyo is a rare industrial business, 2 world-leading niches, a material-to-assembly optical moat, 6 years of operating margins above 20%, and a debt-free balance sheet. The structural demand case is powerful, but optical project timing and foreign exchange create real volatility. Most importantly, the market already prices much of the bright future. The 4-axis score is 12 out of 20, growth 5, value 1, macro fit 5, and supply-demand 1. For the full evidence, assumptions, and sources, continue with Uncover Japan's free deep dives. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.